Want to learn what sets LiveFlow apart from thousands of other QuickBooks Online apps? Do you want to learn how LiveFlow saves time for hundreds of accountants and bookkeepers? Want to learn how LiveFlow helps accountants and bookkeepers to use LiveFlow successfully in their firm? Stay tuned to hear more from our sponsor, LiveFlow, later in the episode.
FTX, according to Morningstar, which is one of the ESG rating agencies, FTX had a higher governance score in their ESG report than did ExxonMobil. And from what I understand, FTX didn't have a board of directors, but somehow their ESG score is higher than ExxonMobil's. Now, if an ESG proponent out there can explain that to me, then I'm all ears. Otherwise, this is all BS.
Coming to you weekly from the OnPay recording studio, this is the Cloud Accounting Podcast.
Welcome to the Cloud Accounting Podcast. I'm Blake Oliver.
And I'm David Leary.
And we are joined today by Ron Baker. Ron, welcome to the show.
Thanks, you guys. I'm honored to be here. I think it's my first appearance on the Cloud Accounting Podcast.
Is it really?
Yeah,
That's hard to believe.
I've been on your mark, but I don't think I've been here. So
well, I can't believe it took us 311 episodes to get there. It's well past due. You, Ron, barely need an introduction, but just in case our listeners are new to you and your work, they should know that you started your career with KPMG's private business advisory services in San Francisco. You are the founder of the VeriSage Institute, the leading think tank dedicated to educating professionals internationally. You have your own podcast and talk radio show on voiceamerica.com, The Soul of Enterprise, Business in the Knowledge Economy. And you are a prolific writer of books, the latest of which is Time's Up, the subscription business model for professional firms, which is my favorite yet. I was very honored that you asked me to write the foreword to this book. Thank you.
No, I was honored you wrote it.
It totally fit with my experience. Started my own firm, worked for a big firm, and I got so frustrated working inside of a large firm, filling out timesheets, when I felt like it just didn't make sense when I was trying to convert all these clients to monthly fixed fee subscriptions. Like the whole thing was just painful. And the way that you've laid it out in this book, I feel like should convince anyone that subscriptions are the way to go and it's the future. So,
well, Blake, I can't believe we're still in the year of our Lord 2022 having this debate about timesheets. I mean, I'm over it. That's kind of why the book is called Time's Up. It's like, this is it. If this doesn't blow up the timesheet, nothing will.
I love that. Well, the subscription economy, understanding that better could be the key to it. Yeah. David, hey, how are you doing, by the way?
Good. I'm going to ask Ron before we talk about his book and get in the news.
Yeah.
So Ron has thousands of books sitting there in his office. And I suspect, Ron, you read. I do. You read a lot. How do you read? Like, do you dog tag all the books? Are you writing down notes inside the books, constant post-it notes, or do you just read it and then move on from there? Like,
from 2009 or something, it's all Kindle. I haven't been in a bookstore, and I rarely buy hardcover or softcover books unless they're not on Kindle. Then I might, if I really want to read it. But that'll prevent me. That's a hurdle for me. I like to read digitally now, and then just highlight and then capture the highlights.
You do the highlights right in the
Kindle.
The Kindle. Okay.
I like that about Kindle is you highlight and then you can export all your highlights later. That's great.
It is great. It makes researching and collating some of your ideas much easier. Whether you dump it into Evernote or some other format, it's really helpful.
How long have you been working on this book, Time's Up, Ron?
Well, it's been 4 years in research, and then it was really written this year from starting in December of last year, and then it was due, I think May 11th was the sword of Damocles hanging over my head when the thing was due, because what the printer told me, or what the publisher told us, was, you guys, if you don't submit this manuscript on time, it's not going to get into the printer's queue, and there's a paper shortage, and apparently there still is one.
A paper shortage?
A paper shortage in the United States of America, which I can't understand. It's really an interesting time period. I just got tweeted this morning that you can subscribe to an apartment. So rather than renting, you subscribe. And people say, well, what's the difference? Well, it goes month to month. You can probably get out anytime you want. And there's probably something plus about it. That's the thing that most people don't understand about this model is you cannot go to the market with a common offering with subscription. It's got to be uncommon. If you go to the market with the same old thing that every other firm is talking about, oh, we do CAS, we do advisory, we do this, it's a common offering, you're going to have common pricing power. But if you go to the market with an uncommon offering, that's where you get pricing power.
Well, you have been talking for a long time about concierge medicine. I think that's one of your examples that you give in your talks about subscription pricing and fixed fee pricing and value pricing. And that just became real for me in my own experience. My parents are getting up there. They're in their 70s now. And they got tired of having to wait for appointments to meet with their primary care doctor now that it's getting more frequent. And they just subscribed to a concierge medicine practice. For $6,000 a year, they get the phone number of a doctor who they can see the next day and whose office will handle all of the logistics of booking any specialist, any appointment. It's truly concierge. I have a problem, I call, and it's taken care of. And you've really called that as like the future of medicine. And I see it happening here in Arizona.
The first concierge medicine was MD Squared, started by a guy named Howard Moran, who was the Seattle Sonics basketball team doctor.
Mm-hmm.
And he said, hey, I know everything about these guys. If they get injured on the court, I can run out there and get them back in the game instantaneously because I know their medical history. I know what they're allergic to. I know everything about them. Why can't I do this in my practice? He was a general physician. He says, well, because I have 2,400 patients. I get to spend 5-7 minutes with them. Half that time is, typing into the electronic health records. He got frustrated with this and said, no, we're going to start MD Squared. At the time, it was $24,000 a year. So you're going after the top 10, 15% of the income earners in the country, people with more money than time, CEOs and things like that. And he limited each doctor to 50 families. That was it. He said, you can't do more than that because we have to be available when they need us on demand, which means we have to have tons of excess capacity. There's no waiting room in these doctors' offices. You come in, they shut the door and lock it behind you. And the average appointment with a DPC doc, a direct primary care doc, or a concierge doc is usually over an hour.
Wow.
Because they're not interested in just helping you when you present with a problem. Yeah, that's great. They'll present, you present with some rash or some sickness or, okay, yes, they'll try and they'll get you better. They want to keep you healthy. You're making an investment in your health. Health, wealth, and wisdom. Those are the three things that sum total a human. And two of them are incredibly important to invest in. And doctors take care of our health. CPAs take care of our wealth.
Yeah.
And wealthy people will invest in that. And they'll invest big in that.
Yep. So if you, as an accountant, an accounting firm owner, want to have a practice that isn't stressing you out and isn't making you work a zillion hours, this is a real model to look at. How do we have fewer clients? How do we charge more money to deliver better services, to have a more personal experience, or a more, hands-on experience with the clients?
A more dramatic impact on the customers we're privileged to serve. Which, I've been obsessed since I've been researching this book, asking professionals, why'd you enter your profession? Been asking doctors, lawyers, consultants, why'd you enter the profession? I never hear to bill the most hours. I never hear to do the most tax returns during busy season and not see my kids. I never hear to have the most customers. I hear to help people. You can't help people if you got 1,000 customers.
Mm-hmm.
Relationships don't scale. And I know people freak when I say that. I'm not saying that businesses based on relationships can't scale. I'm saying relationships, one-to-one, don't scale.
Yeah.
There's that Dunbar number, 7,500 people. That's about all we can handle. And if you do that, then you can have a dramatic impact on their lives, not just give them services.
It's interesting because I was just talking the other day on the Earmark podcast that I do that you've been on, Ron, with a firm owner up in Salt Lake City. The firm's called Mazuma, and it's all subscription based. There's only 2 tiers of pricing. Get this, I think it's $120 a month and $180 a month. They have 6,000 clients paying that monthly fee, one or the other, and they do their monthly write-up work. They do a tax return, And depending on the pricing plan, it includes a personal and a corporate return, or maybe just the corporate return. And I'm thinking to myself, wow, like most firms, the way they're set up, could never deliver that and make any money at scale, but they've done it with subscription-based pricing. So I wanted to ask you, I guess another question about subscriptions, which is like, why does subscription pricing beat the model we've been using for 100 years?
Because it's based on recurring revenue, annual recurring revenue, rather than reoccurring revenue. Reoccurring revenue is, we kind of know it'll be there, but it's kind of like a rash. We never know if it's really going to come back, or it's just not as predictable. Whereas when a venture capitalist or private equity firm, or even a buyer of a firm, analyzes your firm, it's going to take your revenue, it's going to dump it into two buckets, recurring and reoccurring. Reoccurring will probably be worth one-time gross. Reoccurring could be worth 5-10 times more, because it's predictable, because you have a track record with churn. So a firm that's based on recurring revenue is going to be more valuable when the owner exits. Plus, I just think it gives you more control over scaling, because it throws off that predictable revenue. You can capitalize on that. You can use that as collateral to go get financing. I just think you have more options. Plus, it just forces you to take care of every customer and try and keep them for life, because it's not looking at the math of the moment, right? We get so caught up in the math of the moment. Oh, gee, the scope changed. Let's go to the Department of Paperwork and get a change request. And but the customer doesn't care, because the services are a means to an end.
Right.
The end are transformations. And we're all focused on the means and the services and the scope of work, and that the customer could care less about the scope of work. Just do it. And if you have the right business model, like this guy in Utah sounds like he does, I'm not saying that every practice has to be concierge. This is a big marketplace. There's lots of room for different price points. I like the Ritz-Carlton and Four Seasons type practice, but this guy, he's running a Hilton Garden Inn, and it sounds like he's killing it. And that's very possible, because he's using a penetration pricing strategy, and he stays in his lane. He probably knows his ideal customer, exactly what he's going to do for them. He's defined by the services and the customers he doesn't have, as all firms are. And you got to stay in your lane. And too many CPAs out there are trying to be Morton's, McDonald's, a vegan restaurant, a Japanese restaurant, because they don't want to turn anybody away. Well, if you're all of those things, I guarantee you all your food's crap.
That's what I love about the subscription economy, and the way you've described it in the book is that you can apply this to any type of firm serving any type of client. And actually, the more specific you are about who you serve and what you do for them, the better this works. And so, Mazuma is doing that super scoped down, very basic, just what you need type of service to get your taxes done, which is what his clients want, which are between, $100,000 and $500,000 a year in revenue. These basically micro businesses, right? And that's all they want. That's all they need. But then you can also build a concierge practice where you're working with high net worth individuals, or people with multi-million-dollar businesses, or they just sold. Maybe you just specialize in helping people who have just sold a business and helping them figure out what to do next. It all works. And it's all just about figuring out like what those people need and what's the price and how can you deliver all those services to them. And we're not trying to do everything.
Right. It's all, people want to jump right into the pricing, whether you're talking about moving from hourly to value pricing, or you're talking about moving from one of those to subscription. And 99.9% of those questions are not pricing issues at all. They're strategy issues. My first question is, why do you have that customer? Here you are with a sweet spot of $2 to $5 million in gross revenue for most of your businesses, and yet you have a handful of companies that have $100 million in revenue. Pick one or the other. Stop trying to be all things to all people. You can't please everybody. You're not tequila.
Well, and maybe that is how the auditors of crypto exchanges got into trouble. We just saw news today. Armanino has finally responded, defending its work with FTX. Armanino was the auditor of the U.S. FTX entity. Interestingly, in the article, they mentioned that this crypto practice they had only had 9 people in it. And only represented 1% of the firm's revenue. So I wonder if like the reason that Armanino and Mazars and what was the other one, Prager Metis have gotten in trouble with this is because they were getting into something that they really didn't understand.
And I think that stat, like you just really lays into the art we talked about last week and why that they didn't want the exposure, like the negative publicity. It's just not, it doesn't produce enough revenue. It's not a big enough chunk to the firm. Like why, just get out of it. That's why
they all
get
bailed
out of it because it's not worth it. It's not worth the risk for 9 employees. Just not.
Yeah.
And you know that on that, we have a principle, the AICPA. It's one of the 6 foundational principles of being a CPA, and that is do care. If you've never done it before, if you don't know what you're doing, you're prescribed from doing it. You shouldn't. You got to turn it over to a member who's done it before to at least guide you, teach you, or review your work. I think we violate due care all the time because we're just not willing to say no. We just think we can do anything. And I tell you, it'd be like being wheeled into the OR and having your doctor over you going, "Wow, look at that! I've never seen that before." No, give me the guy who's done it 10,000 times. Don't give me an amateur or somebody who dabbles on it on the weekend.
This episode of the Cloud Accounting Podcast is sponsored by LiveFlow. One thing we haven't talked about yet is how LiveFlow helps accountants and bookkeepers to use LiveFlow successfully in their firms. For starters, LiveFlow has amazing customer support. They offer instant help 24/7 from real humans via chat, or if you prefer, you can schedule a Zoom meeting, choose to call them, or even email the founders directly. LiveFlow has a library of plug-and-play templates such as consolidated P&L and flash reports to enable and scale across your clients in a snap. They also have dozens of blog posts from other LiveFlow users where they share their best practices, and they even share their Google Sheets, so you can just copy them and start using their best practices in your firm instantly. In my opinion, this is what really sets LiveFlow apart from thousands of other QuickBooks Online apps, this ability to build, share, and scale on each other's work. Learn more about using LiveFlow and how you can save 20% off your first 3 months. Head over to cloudaccountingpodcast.promo/LiveFlow. That is cloudaccountingpodcast.promo/LiveFLOW.
So thank you everyone who has joined us on our YouTube Live. We stream not every episode, but most episodes on Friday mornings on YouTube. Please find our channel, we're Cloud Accounting Podcast, and subscribe so you get notified. And if you have questions for Ron, you can put those in the chat. Ron, we got a question from Christopher. He said, do we accountants shoot ourselves by inadvertently putting value on the relationships we have with our clients? Do we as accountants shoot ourselves by inadvertently putting value on the relationships we have with our clients? I'm not sure what to make of that.
Yeah, no, it's an interesting question. Yeah, I think I know what he's saying. Because we want to be so pleasing, because we have good relationships, we have a hard time saying no. We have a hard time even pricing those engagements. You know, we all suck at pricing ourselves. But if I'm pricing you, Blake, I can be brave as a lion. This is why actors and authors have agents. It's not because they like to give these people 15% of their gross. It's because they can get them a better price when they negotiate deals. And we suck at pricing ourselves. So I think that's kind of where he's going with that. But I think the bigger problem is we are monetizing the services. I want to monetize the relationship itself.
Tell me more what you mean by that. Going from monetizing the services to monetizing the relationship?
And I don't mean to be involved in a financial transaction with your customers. I know that sounds odd, but what I'm saying is we need to stop monetizing services and scope of work. We're so much greater than the sum of our scope of work. Just to invest in that relationship,
right,
and to keep your eye on customer lifetime value, because that's the end game here. Subscription businesses are creating lifetime annuities that are more valuable, far more valuable, sometimes between 3 and 8 times more valuable than the cost to acquire them.
Yeah.
And that's what we need to track, but we're not tracking that. We don't track churn. We don't track customer customer lifetime value, because we're on that fee for service treadmill, just like the doctors are. We're not doing things for our customers. We're doing things to them because that's how we get paid. The only way I can get paid is if I sell my hands. And I think that sells ourselves way short.
Well, maybe that's part of how these crypto audits got in trouble, because what was Armanino selling? What was Mazars selling? What was Prager Meta selling? There were a couple, it sounds like really only 2 actual audits that happened of FTX. In 2021, there was some sort of actual, what we would call an audit.
A GAAP audit.
A GAAP audit. But mostly that's not been what these firms have been doing, it turns out. And this is where the massive confusion in the market exists. These firms have been doing proof of reserves reports,
right,
which are in the accounting lingo known as, I've heard them described as attestation reports in the news, which I never learned that. I don't remember learning that term in my auditing.
I think it's kind of a new thing. Yeah, kind of like an opinion letter or something, yeah.
But then when you dig into these proof of reserves reports, so-called, which I don't think is actual auditing lingo either, that's made up as well, that's new, what you find is that these are just agreed upon procedures engagements, which is a type of engagement where it's not an audit. Let's be very clear. It's not a GAAP audit. There's no, not necessarily any review of internal controls. There's no assurance provided other than that certain procedures happened. And so I think that's what we fundamentally have this issue with this confusion, is that Mazars, Armanino, Prager Metas are doing proof of reserves reports, which are supposed to validate that certain assets existed at a certain point in time and were controlled by the entity that says they control them, right? But we don't know what they did, and there's no comparison to liabilities. So really, the reports don't mean anything, right? They provide, and they say that in the documents, that they provide no assurance. So here we have audit firms providing reports to the client, who's then giving them to the public. Public thinks that these reports provide assurance. They think that they're audits. And in many cases, the clients were actually saying, we got an audit, when all they got was an attestation report. But the public doesn't know the difference.
This is the difference of the focusing on the services you're providing versus the relationship, right? And the COO of Armanino flat out has said now, this is in today's article, the firm's auditors weren't tapped into looking into internal controls at FTX. And then auditing the internal workings of a company is not a requisite for private corporations. So they have their out, right? They're focusing on the service they provided or did not provide. But the crypto companies, and I keep talking about this, they keep exploiting the relationships. As soon as they're like, okay, hey, now I have the name, I'm going to put that everywhere, and people don't know the difference. And so the crypto companies are exploiting the relationship, and the accounting firms don't even know. They're just trying to provide, they're too focused on the service they're providing. And they're missing the whole point that you're being exploited by all these crypto people. That's a really good point.
Yeah. The crypto firms engage with these firms. The crypto exchanges engage with the firms, get the attestation report, pretend the attestation report is an audit. And this is where I think we ran into ethical problems as a profession, is nobody stood up and said when they started holding this out as audits, by the way, these don't provide assurance. Like the firms didn't do it. AICPA didn't do it. Nobody did it.
That didn't happen.
I mean, David, you and I were looking on Tether's website back in like January after the collapse of, was it Luna? And we were looking at these attestation reports like that were provided by, I don't know who did it at the time. There's a Cayman Islands firm, and now it's like BDO Italia. Like these reports are meaningless. But every time you go on Twitter and you say Tether is not backed 1-to-1, people will come out and say, oh, but they have this proof of reserves report. But we all know the proof of reserves report is just a snapshot at a point in time, and we don't know what procedures were actually done to validate that these, reserves exist. I mean, all you need to get is one partner in a small team in a big firm with a good logo to sign off on it. And we know Italians never take bribes, right? That's not a thing they do.
Guys, I think this brings up a much bigger issue. Not only are these proof of reserve reports completely useless, but so is the audit. The audit's completely irrelevant. There's no right way to do the wrong thing. And the audits have become, I think accounting has become a deteriorating paradigm as we make it more and more complex with all these dumb FASB rules that keep coming out. It's what philosophers call a deteriorating paradigm. It gets more complicated as it explains less and less. And that's where we are. And the audit itself is useless. So certainly these letters of attestation are no better and far worse probably.
Let's dig into that more, Ron. David, I know you have a follow-up question. Like, I want to talk about this problem with audits because I feel like this is like fundamental to the future of our profession, and it doesn't get talked about.
Before you talk about
enough.
the problems, can we just talk about the news that came out this week and the numbers of the problem with audits?
Yeah.
PCAOB?
Oh yeah. Let's talk about PCAOB inspection
PCAOB has their oversight. They released this report, right? And basically 1/3 of all the audits failed, and they keep referencing.
Wait, David, you got to say that like 3 times. How many?
1/3 of these audits have failed, and when I say failed, the firm and the audits appear. So they keep referencing this Part 1A of the report. I'm like, what is this? So I Google it. So Part 1A of the individual audit firm's inspection report discusses deficiencies, if any, that were of such significance that the PCAOB staff believes the audit firm, at the time it issued the audit reports, had not obtained sufficient appropriate audit evidence to support its opinion on the public company's financials.
Okay.
1/3 of the time, they have to put them in the exception box.
Let's turn that into normal speak, plain English. Okay. So what that means to me, I'm a CPA, right? But I never did audit, but I'm just trying to interpret this. And Ron, maybe you can interpret it for us and tell me if I'm right or wrong. It sounds like what they're saying is that the PCAOB, how many audits did they inspect? It was like 100 they inspected 141 firms. 690 audits were reviewed. Okay. So 690 audits reviewed. 1/3 of those audits that they looked at, they said the firm didn't do a good enough job to actually support their opinion on the financial statements being accurate and without material misstatement, right? All the stuff that you...
Yep.
Right. So if I'm using those financial statements from that company, I can't rely on them, is what the PCAOB is saying. 1/3 of financial statements can't be relied on. That's what that means to me. Like, why is that not bigger news?
It should be. This is my rail against the monopoly of the audit. It's the only thing that CPAs have a monopoly on, right? And anything else we do as CPAs, there's plenty of competition from non-CPAs, consulting firms, wealth planners, blah, 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 tax accountants, EAs, blah, blah, blah. So we have a monopoly here with a 1/3 defect rate. Sounds to me like the public schools. Half of the students they churn out can't read at grade level and don't know science and history and things like that. Why do we keep supporting this monopoly? If this was any other business, we wouldn't tolerate. We didn't like AT&T. We don't like our local utility company. But when it comes to this, we all want a monopoly because, it's there to protect the public. It's doing no such thing.
Yeah.
This whole independence idea is a complete joke. We're not independent. You can't be paid to be independent. The stock market should be hiring and paying the auditors for the companies that are listed on their exchanges. And at least that would be more independence than we have now. But I still think the product itself is defective.
Yeah.
Yeah,
I mean, and it's not just like a small defect. It's 1/3 of audits are totally defective. That's what that...
And only 5% of investors even look at them to make it. I mean, Baruch Lev has proved this point over and over and over. Even if he came out with a report, you might have seen it in Accounting Today, even if you could predict earnings per share for every company.
I saw that, yeah.
You still wouldn't make any money.
So
because it just doesn't matter. The market's not looking at the accounting data. Auditors come in after the war and they bayonet the wounded. It's crazy that we force companies to pay all this money to comply with something that nobody looks at.
But the ripple effects are true. And it just came out this week, the whole nobody looking at the Trump tax returns. And the reason why is the IRS agent basically says, well, he hires a professional accounting firm. At the time that was Mazars, right? And the assumption is they do their job properly and properly make sure all the income and deductions are reported properly. So we probably don't need to spend time auditing it. And that's the point of view. So the whole entire IRS, when it comes to auditing, they assume these big firms are doing their job correctly. And it's very clear they're not 1/3 of the time.
And I think it was like there was one agent was assigned to audit Trump with 400 LLCs. Can you imagine that? Like, you get that assignment, you're like coming into work. Hey, Bob, you've been with us for a few years now. We've got an assignment for you. Enjoy. Here's the files. Like boxes coming in. Like, he had no choice, no chance, right? No chance.
This episode of the Cloud Accounting Podcast is sponsored by LiveFlow. Think about this. If you have approximately 60 clients and create 5 reports a month for each of them, that's over 3,500 reports a year. And let's say you're really fast and it only takes you 1 minute per report. That's almost 2.5 days a year you spend creating reports. Here are a few of the ways LiveFlow saves time for so many accountants and bookkeepers. Once you create the perfect suite of reports for a client, you can just copy the Google Sheet, use LiveFlow to connect it to a different client's QuickBooks Online company, and you're all done. The new reports will pull in the data for the second client automatically. You can easily drill down on the details of each number on a LiveFlow report, including drilling down to the transaction level to navigate directly to the transaction inside of QuickBooks Online. No more opening QuickBooks Online to search for specific transactions. LiveFlow and Google Sheets are in the cloud, so you don't have to waste time emailing files between your team and your clients. And you can give your clients access to a suite of reports that they can access anytime, eliminating one-off requests for you and your staff. To learn more about using LiveFlow and how you can save 20% off your first 3 months, head over to cloudaccountingpodcast.promo/LiveFlow. That is cloudaccountingpodcast.promo/LiveFlow. Stop manually updating your spreadsheets with LiveFlow. And it comes back to faith in the industry, right? So there's a forensic accountant in this article talking about the Trump's returns. And he goes on to talk about how at some level you have to be like, okay, look, the returns are all computerized. They're done properly. I've got some level of faith that somebody in their quality control process, as in that somebody being the firms, right, are doing this properly. And this is the same assumption we have as the public. Like, oh, FTX had Armanino. We have trust them now. There's so much trust that we're giving all these big accounting firms. And
do they deserve it?
I don't even know if it's deserve it, but I think in general, the public is very naive to the fact that 1/3 of these firms, it goes like I talk about 99, even 99% is not great. Go buy 99.9% dust-free cat litter. It's not good enough. Right?
Yeah.
It's horrible.
Yeah. If FedEx had that defect rate, we'd go nuts.
Yeah.
Or UPS.
But 1/3 is crazy.
One third of the entire audit cannot be substantiated. The opinion that what does that mean? That means, think about it, that there are Fortune 500 companies, and 1/3 of them, the financial statements might be totally wrong, right? It's possible that they're wrong.
Well, we know they are wrong. I mean, we know that already. It's just that what's the magnitude of the error? I mean, this is something economists have been saying for decades. When we issue reports, we put out the magnitude of error, which in our lingo would mean we would report the materiality and say this could be within 10,000, 100,000 either way. Yeah. At least the public would know that no, this isn't buttoned down.
Yeah, why are audit opinions yes or no?
Yes.
Right. Why is it pass
agreed.
or fail?
It should be a movie review. Audit opinion should read like a movie review. This looks good, but we're really uncertain about this and this, or like an autopsy report, It should go through and it should give the auditors, subjective opinion. But they don't want that because that opens them up to liability and being sued if things are more subjective.
Well, and when you're getting paid by the client, it creates a lot of awkward
you might lose your consultant
situations, right?
That too.
Because you're not really independent.
You're not independent. It's not independence. I've had this conversation with the AICPA, and I just can't believe it. But they say, but the board of directors, the audit committee hires the auditor. I don't care. Are they spending their own money on the auditor? It's who's paying them that matters. Mm-hmm. Just the appearance of that is bad enough to blow it up by our own standards. You have to be independent in fact and appearance. Yep. This doesn't pass that test at all.
And we didn't even get to part 1B of the individual firm inspection reports by the PCAOB. Let's see. Those deficiencies, I guess, are less bad. I'm not really sure.
Less bad. I love it.
Less bad. There's the really bad and the less bad. So apparently 40% of the audits that they reviewed had a deficiency of part 1B. So it's more than part 1A, which is the more serious one. That's 1/3, right? 33%. Then it's 40% for part 1B. And if you add up all the part 1A and part 1B deficiencies, all the different types of deficiencies, over half of audits had problems.
Deficiencies.
55% of engagements. that
Did
they
they
reviewed.
report the size of the firms that they analyzed? Was it like in the top 100, top 10, top 20?
They gave out.
They inspect, theoretically, they inspect a random sampling of all audit firms, don't they? It's not done by size or anything.
Be my guess, but I don't know.
But a lot
That's what I've always assumed.
The report feels like a lot of top 10. It's like EY, 12 of the 5056, PwC.
Okay. Yeah, they would be the predominant.
18 of 16.
Yeah.
Deloitte was the number for them. 7 of the 54. So they're going through BDO USA. They're going through all the top.
So here's, the funny thing about the auditing topic is only 15%, maybe less now, of CPAs are deployed in auditing, financial statements. And so most of this is just absolutely irrelevant to small firms.
Right.
Absolutely irrelevant.
But it pulls down the brand. Like the CPA brand has a lot of value. And I feel like when these meaningless audits confuse the situation and we have failures like FTX and, Enron, of course, is the classic from my generation growing up, right?
Sure. There's one every decade.
Yeah.
You can go back every decade and find a massive audit failure.
Yeah. And
Penn
I think
Central, it goes all the way back.
It destroys the public trust, or at least it has an impact on it, maybe.
But it doesn't matter because it's a monopoly.
Right.
Companies have to have it, and they have to hire a CPA. They have to hire one of these big fours to do it.
Right.
And that's the problem.
And this is why, like in crypto, people weren't clamoring for audits because they actually know that they don't mean anything.
Well, the venture capitalists that invested certainly weren't clamoring for it.
Yeah.
And these are sophisticated investors. That's about as sophisticated as you get.
Yeah.
But they were sold on this SBF guy like he was some type of wonderkin.
Well, so I like to think of this problem as not just being limited to, the big four or the audit firms. You said what percentage of the profession is
15%
doing audit?
or less.
That's it, really?
That's it. Swear to God,
but
that's it.
It has an outsized impact on the future of our profession.
Has an outsized impact on everything. All the regulations. We teach ethics in California. We have to do a regulatory review update. 90% of the California State Board of Accountancy regulations deal with attest services or are drafted because of attest services.
Yeah.
They have nothing to do with much else.
So one of the problems we have in our profession, probably the biggest one, is that we aren't producing enough accountants. We aren't producing enough CPAs. People are not wanting to come into the profession to go be auditors and do entry-level tax, right? That's where you get started. I don't know if it's still the case, but I feel like, judging from what I see, most of the new jobs, the entry-level jobs that you get out of school, are at big firms. Larger firms are willing to train. They have the capacity to do this, right? You come in, and that's the traditional path. You go work for KPMG like you did, Ron, right? And you cut your teeth on it, and then you go and do something else, or maybe you keep going. But maybe the reason that accountants don't want to go work is the pay is low. That's another thing that people talk about, is like the pay for auditors is really, really low. The work is not it's not meaningful. And so maybe the problem is that like the work's not meaningful because we all actually fundamentally know deep down that the audits don't mean anything. And maybe the pay is low because the public also knows this. So they're not willing to pay for audits because the audits aren't giving them useful information. Like you said, the Baruch Lev did that story that, only a small, tiny percentage of investor decisions are made with audited financial statements.
Right. Just look at the downloads on Edgar.
A few
There's
dozen,
something
right?
like 30, It's absolutely amazing.
So that's the website where you can go and download audited financial statements, publicly issued financial statements. And only
There's tumbleweeds.
Most financial statements are only downloaded a few dozen times at best.
So you
are you
guys
just
have
saying
more
like
live
this
listeners.
is a cycle of apathy? Blake, is this what you're saying? So I have a job in audit. I know nobody's going to read these numbers. Nobody really cares. So I'm just going to half-ass the job. And then nobody cares about the audit because they know you have to ask the numbers and they don't mean anything. And it's just like this. We're trapped in this cycle of apathy where we're just doing it because there's a law that says it has to be done, and that's it.
And there's money to be made to do it, right?
It's a lot of money. Apparently.
A lot of money.
And only the big firms can do the big companies. I mean, there's no way a top 20, 50 firm could audit General Motors or Toyota or something like that. I mean, that's why the big four they have that secure base because it's a compulsion. People have to do it.
This episode of the Cloud Accounting Podcast is sponsored by Zoho. I'm sure you've heard of Zoho before. We've probably even mentioned Zoho CRM or Zoho Books on this podcast in the past. But do you really know about Zoho? Did you know that Zoho offers an entire suite of solutions to run your firm, including a CRM, expense tracking, bookkeeping, a full office suite, a support ticket system, and workflow automation? Did you know that Zoho offers a suite of solutions for your clients' bookkeeping, including bookkeeping, inventory, invoicing, subscription management, and a checkout app? Did you know that Zoho has an accountants program? Did you know that Zoho advisors get free access to 8 Zoho applications and a dedicated account manager? If you want to learn more about becoming a Zoho advisor, head over to cloudaccountingpodcast.promo/Zoho. That is cloudaccountingpodcast.promo/ZOHO.
So I got to get back to the chat because this conversation between the three of us has stimulated some discussion. D. Hall says, with an audit that fails, the only accountability would be from stakeholders, and the stakeholders have to show that damages occurred. A company making profits has no damages until collapse. And he also said, auditors are in a position of low risk. Audit managers manage risk, not assurance of materiality.
I can't disagree with that.
So what that means is like when I'm managing risk, it's like I'm managing the risk that there is a material misstatement. My goal as an audit manager, like this is not what it's supposed to be according to our ethics, but my goal is to give them a clean opinion.
Right.
Right.
I would just say on the managing risk, I don't think the auditing profession does a great job managing risk because they're using hourly billing to price these big audits. And I've talked to actuaries about this who price risk for a living, and they say there is no model in actuarial science to price risk by the hour because the time that you spend auditing a company has no direct correlation to the risk.
Right. But
you're taking.
But your goal, this is where the whole business model has created this perverse system because your goal as an audit partner is to issue a clean opinion, to not have any material misstatements. And so you use the cheapest, least experienced people you can because they are the least likely to find anything. Right?
That's a cynical view, but yeah, I think there's some truth to that.
I mean, it doesn't.
Sure.
It's not like anyone, decided at one point like that's what I'm going to do. It just sort of happened, right? It's systemic.
It's the system.
Yeah. Nobody planned that.
Your bonuses, if you're in an audit, is not based on like all the cool stuff you find that's illegal or needs to be caught. Your bonus is probably based on the number of hours you billed for or pushed through.
Absolutely.
Yeah.
And your realization.
Oh, I bet if you find fraud, if you actually find like real fraud, it's a huge inconvenience to the audit engagement team because now they got to go do a whole lot more work, right?
The guys on Oh My Fraud talk about the percentages of how fraud is uncovered.
Yeah.
And what is it, like 2% that come from the auditors? More come from the internal auditors if the company has them.
Yeah, it's only a few percent of frauds are detected by the external auditors. And this is another huge misunderstanding the public has with audit, which is if you go ask somebody on the street, is an audit supposed to detect fraud, they would say yes.
Oh, absolutely. And this is our fault as a profession. But see, we don't want to engage in this discussion. We want to have all these picky-cane rules about, if your brother-in-law from your third marriage, twice removed cousin owns a share of Disney and your firm audits Disney, does that impair your independence? I mean, none of that matters.
Yeah.
We get caught up on all these little independence rules, but the big problem is you can't be paid to be independent.
Yeah. Well, I think this fundamentally is why like the profession is having trouble recruiting people because I think whether or not they can express it, young people want to have a meaningful job, and audit, which is one of the key ways that they enter our profession, is not meaningful as a whole.
When you talk about the problems with attracting talent and retaining them and all of that, it's like, stars don't work for idiots. If your business model sucks and I'm a star knowledge worker, why would I work for you? EY or KPMG, why wouldn't I go work for Google or Apple where I could make a dent in the world?
Yep. Christopher in the chat says, the kid who asks if there's homework after the teacher never brought up homework. I think he's referring to an auditor who actually, does their job. They get punished.
Finds fraud.
Yeah, the auditor who finds fraud is like that kid, right?
Yeah. Is there going to be homework? Yeah.
We all want to go home. Don't find anything.
Right? This is tangential issue, but I think this is interesting too. And I know you guys have talked about ESG, but I think this is one of the reasons the profession is so excited about ESG, because they see it as something more relevant than the audit. But and I'm a big critic of ESG. I mean, you won't find somebody who's more opposed to this than I am. I'll just give you one.
Myself right there.
I'll just give you one data point.
Okay.
FTX, according to Morningstar, which is one of the ESG rating agencies, FTX had a higher governance score in their ESG report than did ExxonMobil. And from what I understand, FTX didn't have a board of directors, but somehow their ESG score is higher than ExxonMobil's. Now, if an ESG proponent out there can explain that to me, then I'm all ears. Otherwise, this is all BS.
Well, I guess I
can't argue it.
I mean, we're with you on that, Ron. It's like we've looked into ESG a little bit on this show. And for those listening who aren't, familiar with the acronym, it's, what environmental, social, and governance is the term. And to me, I think like the biggest problem I have is it just seems like this mishmash of different things that aren't related.
They're all contradict. The E and the S and the G all contradict. Let's give you one other data point on this. If you look at the credit rating agencies that, grade companies and corporate debt and all of that, they have like a 95% correlation between it. So, one of them's given a company A+ rating, then there's a 95% chance the others will. ESG's different rating, and there's lots of them. They have a 54% correlation, which means there's no, I defy anybody to give me a definition of ESG, actually define it, and then go more granular and define the E and the S and the G. Good luck with that. You'll never find a definition. You'll only find all these, highfalutin phrases. But then there's no metrics for it. There's no meaningful metrics. It's all subjective.
We brought this up on the show, and the AICPA conveniently has a company in their CPA.com cohort, these companies they invest in, they nurture or whatever, that calculates all this. And like, that was the answer. Like, of course they can calculate. We have a company that does this. I'm like, okay.
And you'll hear, but the metrics are getting better. Really? Is that why FTX has a higher score than Exxon? Is that why the Chinese chemical company or the Chinese oil company, state oil company, has a higher ESG score than Exxon? Is that why the Russian bank? There's a bank in Russia that has a higher ESG score than JP Morgan. How does any of this pass the sniff test?
Yeah.
This is just nonsense on stilts.
It's arbitrary and it's marketing, right? It's like everybody wants that ESG. They want to say that we're doing good for the world, right? Because that's what the people want. But in the end, the firm selling these scores, it doesn't mean anything.
Accenture just issued a report. This was in the recent, a couple weeks ago in The Economist. Accenture issued a report. 93% of the companies that say they are going to go net zero by 2050, 93% of them are not even close to getting there. They're just mouthing this stuff because just like SBF, he knew if he mouthed this stuff, then he would make friends because it sounds good. I'm trying to save the world.
So I want to bring things full circle, right? And I think I have a way to do that because it seems to me all this obsession with ESG is because the thought leaders in our profession know that there's all these like fundamental issues with accounting standards and auditing, and they don't actually want to deal with that. Nobody wants to address the real problems facing the profession, which we've just spent 40 minutes talking about. So I won't rehash that. So we say, let's go do ESG, right? New big opportunity. We can change the world. Auditors can, I don't know, like make the world a better place.
Save the planet.
Save the
distraction.
Planet. Yeah, right.
Yep.
But meanwhile, our accounting standards don't work in a subscription economy. And they still don't, even though we've had subscription-based businesses growing and becoming some of the most valuable companies on the planet over the last few decades. They still don't properly account for those kind of businesses. And I think for me, the book that made me realize that first was, or gave me the inkling of that was Teen Swo's Subscribed, Ron, which you have spoken about, and that's how I found out about that. And he lays out this concept of this subscription economy income statement. And really, when you dig into GAAP and you look at how it handles subscription businesses and how it handles I don't know. And what it does now, it just doesn't work. Like a subscription-based business is punished for using GAAP accounting because GAAP is all about making a product. You capitalize all the costs, right? You accrue all the costs of creating that product. That's inventory. And then you take it to market and you sell it. And the difference between your cost and your sale price is your margin.
Right. And there's matching. So you're trying to match, with the cost, with the period and all of that.
And fundamentally, if it's actually really, accounting is actually really simple when you think about it. It's all just about matching those expenses that happened a while back with the income we're receiving now and being able to see how did I do? What is my margin on that product? And that worked great in the industrial economy because that's how businesses worked. You made something in a factory, you took it to market and you sold it. And calculating that margin allowed investors to see which companies are effectively managed, right? Which ones are efficient and which ones aren't. But now in a subscription economy,
that's out the window.
It's flipped.
Yep.
We go get the customer first and then we deliver the product or service.
Yep.
And our accounting doesn't know how to deal with that. And it mismatches the income and the expense.
You'll appreciate this. I'll say this really quick. I met the bookkeeper who was the bookkeeper for MD Squared when they opened. Now, MD Squared, by the way, I don't think I said this, the concierge doctor that limits 50 families to each doc. They started in 1996. They're the largest concierge doctor practice across the country. So they've been around for 26 years. Shows you how far behind the curve we are. But she was their bookkeeper. I met her at Scaling New Heights. She came up to me and Ed, we were sitting there having a drink, and she goes, I'm so glad you talked about MD Squared. She goes, I couldn't get my head around it. She'd go to the controller, CFO, with a check for whatever the monthly subscription amount, $2,000 or what. She goes, where do I code this? What did we do for this guy? She wanted to match it to something. And the CFO looked at her and goes, we did whatever he required. We don't track that. He's paying for access to us when he needs us. You just can't do that with GAAP. You have to match, and you have, and there is none of that.
Well, you can match though. I think there's a way, and Teenswo kind of lays that out in broad strokes in Subscribed, and you talk about it in your book, that you can match up the recurring revenue with the recurring expenses, and you can get a recurring profit, a recurring gross margin.
That's a category.
Yeah.
That's a categorization, not necessarily the matching principle. But yes, absolutely, that's true.
Well, and that, if you think about it, that's what I as an investor care about when I'm looking at a subscription-based business. Is I want to know, okay, what is your MRR, your monthly recurring revenue, or what is your annual recurring revenue? And then I want to know, what are your recurring costs to deliver that product or service to those customers without them churning? Right? Like to keep them happy. What does it cost you? And then, what's the difference? That's the margin. That's the recurring margin. And that is how investors think when they invest in subscription businesses. They want to know, is that a big margin or is that a small one? Because that determines the valuation. Can I increase that margin? The same way in a factory, you would, increase efficiency to reduce costs, right? An investor can look at a subscription business and say, oh yeah, we have too much capacity. We're going to reduce our capacity a little bit, and now we're going to have bigger margin. Right? We're going to still be able to service the customers, kind of idea.
Right. I mean, it gives the Teenswo's subscription income statement gives the investor enough to do customer lifetime value modeling as well. But as Teen takes it a step further, he says, if I see net income on a subscription-based business income statement, he said, I kind of score them negatively. I want them to plow back their net income into customer acquisition. He says, as long as the bucket's not leaking, then we're growing CLV, customer lifetime value. It's just a different mindset because it's a different profit formula.
Well, yeah, exactly. And this is where GAAP messes up and doesn't provide useful information to investors because, like you said, a subscription business that is properly managed has little or no or even negative net income on purpose. They don't want...
By design.
By design, you want to take all of your cash and you reinvest it in adding more customers because those customers are an asset. Your customers are an asset in a subscription business. And that is completely incomprehensible to most accountants, to current accounting theory. The idea that a customer could be an asset on your balance sheet. But I think we actually might need to consider, how do we do that? Because investors do it. That's what lifetime value is. It's a way to measure the value of a customer. And you could actually put them on the balance sheet. You could calculate your lifetime value. You could multiply that by the number of customers, and you could put the customers on the balance sheet.
Yep. I mean, this is why Jeff Bezos, not that Amazon's a all subscription. It's not. It still sells a bunch of SKUs. But this is why Jeff Bezos' metric that he was fanatical about was free cash flow. He says, I don't give a crap about margin. I can't pay the light bill with margin. I have to work off free cash flow.
Yeah.
And subscription makes it easier to do that as well.
Well, and
because it's predictable.
If Bezos looked at traditional accounting reports like cost accounting, if he used cost accounting in Amazon, he never would have done Amazon Prime. Yeah. Because Amazon actually loses money on most orders under $10 because it costs them, theoretically, according to cost accounting, it costs them more to deliver a $5 pack of toothbrushes than they make from that order. But Bezos understood that he's building up subscribers to Amazon Prime. So it doesn't matter that he's like theoretically losing money per product on all of these little items because he makes it up through the whole customer relationship, that people are willing to spend thousands of dollars per year as Amazon Prime members to have everything delivered in 2 days, which they wouldn't do if 2-day delivery didn't exist.
Plus, they spend 4 times more than a non-Prime customer with Amazon.
Yeah. And an accountant would have looked at this and said, no, you can't do it with Prime. We're going to lose money, right?
Well, cost accountants would have told Netflix when they sent out that email to people that said, hey, you guys, you haven't signed into Netflix in the last 12 months. We really don't like to see our customers pay for things that they're not utilizing and valuing. So we're going to cancel your subscription unless you sign in and reconfirm. No cost accountant would advise them to do it. These are the best customers. They pay every month and they don't use your product. But that's not the mindset you can have. You want your customers. The concierge doctors have to educate their customers to come in more, not just when you're sick. Yeah. We want to see you when you're healthy because we want to keep you that way.
Can you imagine that, like an accounting firm encouraging their clients to call them more?
I know. We put up this barrier of this tech stack between us and our customers, and that's what really worries me, because this is ultimately a relationship business, and you can't do that just through your workflow processes. By definition, relationships are inefficient. By definition.
So, Hey April is in the chat and said, the journal entry under accrual basis for monthly subscription model is debit, cash, credit, unearned revenue. At the end of every month, you book debit, unearned revenue, and credit sales revenue. Yes, that's true, but I think there's more to it than that. Here's my example using debits and credits. So when I go out and I spend money on marketing to acquire a customer, where does that normally appear in a GAAP financial statement? David, let's say I spent $100 and I got a customer for Earmark.
I'm not the accountant. I wouldn't know.
Great answer. It shows up as a debit to marketing expense.
Yeah.
Credit, cash, debit, marketing. But according to my theory of the subscription model, that customer that I acquired is worth, let's say, $500 because they're going to pay me $100 every year for 5 years. And I know this based on my churn rate. I can calculate this number reliably. Yeah. It's certainly a better estimate than many accounting estimates we make. So let's just assume that's true. It's worth $500. So really what happened economically during that month is I spent $100 and I gained a $500 asset.
Annuity.
It's an annuity, right? And I'm going to get $100 this year. I'm going to get $100 next year for 5 years on average. So GAAP financials, all I show is I actually showed if they pay me $100 a year, in that year I show zero profit, right? But I've got 400 more coming. And that's where GAAP financials don't show any of that, right?
Right.
I would be better off on a GAAP basis just selling them the $500 thing up front, and then I show a $400 profit or something like that. And this is where Amazon, like why Amazon looks so unprofitable for so long.
Yep. It's why Adobe, when they made the switch to cloud-based and subscription, the investors freaked out. But now that they understand the model, it's a good thing the market's smarter than the accounting profession.
Yeah. So I think there's a way to figure out how to actually do accounting for that. I mean, we just have to look at how the investors do it in their spreadsheets. But I think we could actually, have a methodology for subscription-based businesses to create P&Ls and balance sheets that actually make sense. I'll
hold my breath for FASB to come up with something. And
that's the problem, is they
ESG's
dick around creating lease accounting standards. Like the lease accounting standard
that are incomprehensible.
It's the least. The lease accounting standard is the least useful accounting standard ever created. I haven't heard anyone say that it's useful. Investors don't care, accountants don't care, managers don't care. Like, why did they create this thing? It's amazing.
Yeah, gives them something to do.
If anyone disagrees and thinks that the lease accounting standard is helpful or useful, please, you can write to me. We're cloudaccountingpodcast@earmarkcpe.com. And Dave, as David says, write to Blake. Don't send your complaints to Blake.
Yes, yeah.
I'm not the accountant. To send your complaints to Blake. Sorry, David, for monopolizing this conversation with accounting nerd theory. I had to because Ron's here. Is there anything you want to add, David, to this episode before I close things out?
I think I'd love. I know we have a little clip. I'd love to play a clip from a new podcast called Booksite.
Oh yeah, let me pull that up.
Taylor Arndt. She is a blind bookkeeper. This is like a teaser clip of her podcast in a way, because what she did is she captured in a podcast, which is just so genius, and I want everybody to go download and listen to it, how she uses her computer. And it works because it's a podcast and it's all audio. You have no visuals, right? It's not a YouTube video. And the way she does it is so amazing. And so this is almost like a teaser clip on how she does bookkeeping, right?
So this is the experience of I'm blind, I'm doing bookkeeping with audio. Okay, let's listen.
Bookkeeping if I'm blind? That's a very valid question, and I'm glad you asked. The short answer is I use a screen reader. I don't use a mouse. I use the computer just by keyboard commands alone. So let me go ahead and demonstrate. As a blind person, I am so used to hearing speech that my screen reader reads at a very, very fast speed.
Media controls window.
All right. So you hear my screen.
Wait, what was that?
You hear a very fast voice, I'm sure. It's pretty fast, and it is probably a little bit robotic to you, I'm sure. So let me go ahead and show you guys how fast it talks.
Zoom row 1 column. Settings row 1 column. Inbox packet with text row 1 column 4. Inbox text. Zoom window. Media settings row 1. Zoom row 1 column 1. Media controls row 1. Settings row 1.
Wow.
Zoom row 1. Media controls row 1.
You're probably thinking, oh my gosh, that is way, way, way too fast. And I'm sure it is.
That's incredible, David.
That is.
So I know we like sometimes it feels like our industry is like hopeless, for lack of better terms, but there's always like great stories. Like somebody who's new to bookkeeping, she just embraced it. She jumped in, switched her career from being a web developer to bookkeeping. And so there's people discovering our industry and getting excited about it. And even with the challenges of like she's blind and she's doing QuickBooks support or QuickBooks work and I think FreshBooks work, and she's doing real bookkeeping work.
That's amazing.
Awesome. That's awesome.
And I assume that if she has a Kindle, I think Kindle has the ability to read the book to you. So you can also, whether you are sighted or not, read Time's Up, the subscription model for professional firms. Ron, do you have a place that you prefer that people purchase this book if they want to get one?
Amazon is good because it's available on hardcover and also on Kindle.
Yep.
And if people want to learn more and possibly join a community, they can go to thesoulofenterprise.com/timesup. And we're doing Q&A sessions, me and Paul Dunn and Ed, and we're going to have other events and other benefits as well. So people can check it out there.
Awesome. And if people want to follow you online, what's your favorite spot?
Twitter at Ronald Baker, LinkedIn. I'm one of the influencers, so they can catch me there. They can also just email me, ron@verisage.com. I'm happy to talk with people or help them out if they have questions or whatever. So
awesome.
I'm pretty accessible.
Thanks for joining us
today. And the book's
today,
about,
Ron.
what, $49 a month? I have to pay you $49 a month?
No, it's a one-time hit, $40. I've got a lousy agent, He's selling SKUs, not subscriptions.
That's amazing. Well, David, if people want to touch base with you online, where can they do that?
I'm on all the socials, just at David Leary.
I am at Blake T. Oliver. You can find me on Twitter, Instagram, LinkedIn, and subscribe to Cloud Accounting Podcast on YouTube. Just search Cloud Accounting Podcast, hit the subscribe button. You'll get notified when we go live, and you can find all sorts of fun stuff like our videos that we recorded at QuickBooks Connect, touring around the QuickBooks booth, learning what's new. If you couldn't make it or you didn't get a chance to go by the booth, now you can go with us and you can see us as well, potentially too. Yeah, that's it for me this week. I hope everyone has a wonderful Christmas holiday and happy Hanukkah and happy New Year.
Thanks, you guys.
Thanks, Ron.
Thanks, Ron.
Great to see
Appreciate
you.
it.
Thank you. You too.
Time for the classifieds. Check out Hector Garcia's new app called Right Tool for QuickBooks Online. Instantly increase your productivity with keyboard shortcuts and more. It will save you seconds. The app is free at the moment in public beta. Check them out at righttool.app. That is righttool.app. RIGHTTOOL.app.
I don't care where you live in the United States. If you're a CPA, you have to take ethics continuing education. And I don't care who you are and where you live, you hate taking ethics continuing education. That's why me, Greg Kite, and my buddy, Adam Browd, we created a podcast called Drunk Ethics, where we unfold and expose all of the inner secrets of not just ethics, but how to become more ethical and to promote ethical behavior at your workplace. And we do that while we are getting progressively more shit-faced during the course of each episode. In each episode, we take 7 shots every 7 minutes. And so at the beginning, we are scholarly, and by the end, we are drunk yet still scholarly. If you're interested in this podcast, which I know you are, anyone can listen to the podcast for free. It's out there. You can find it. But if you want CPE credit for it, NASBA certified CPE credit, it is a premium course on Earmark. So if you're already a subscriber to Earmark, it's going to be more than that. But listen, it's worth it because of 2 reasons. First off, you know your company, you know your firm's going to pay for it and not you. And second of all, it's worth it, damn it.
Want to get the word out about your newsletter, webinar, party, Facebook group, podcast, ebook, job posting, or that fancy Excel macro you just created? Why not let the listeners of the Cloud Accounting Podcast know by running a classified ad? Hit the show notes for the link to get more info.